Just Vote to Enrolled Agent, owner of Rogue Tax Professionals. Today I'm going to answer the question about earned income credit. What is it? Well, earned income credit is a credit that a person can get for having payroll or independent contract work, having what's considered earned income. And if you have enough earned income, even as a low income earner, maybe $7,000, you can get earned income credit. If you don't have children, it'll be small. But if you have children, then it can be quite large. And in fact, that's what people hear. That's what you hear when somebody says, oh, I got like $8,000 back, and they're somewhat of a low wage earner. That's earned income credit. It's typically people who have kids and have a low earned income. And that could be, I think the optimal amount is about $14,000 of earned income with children. Then you can get the most amount, and then it kind of phases out after that. But you can get earned income credit all the way up to, I think, into the 30,000s or low 40,000s worth of income, depending on how many kids you have. And so it could be pretty substantial. And earned income credit is somewhat controversial. People think of it as a handout. Some people think of it as a motivator to get people out into the workforce. But it only qualifies for earned income. So you have to be a wage earner. You have to have independent contractor work. Those are about it. You can't, Social Security doesn't qualify. Retirement distributions don't really qualify. Alimony doesn't qualify. Dividends don't qualify, so you can't actually get that. So now business owners are often kind of cushioned with earned income credit. So you go out and onto your own, you become a business owner, and you make a little bit of money. That money, of course, if you're a sole proprietor, is subject to self-employment tax. Now, if you have children and you get earned income credit, then that will offset oftentimes the self-employment tax, and you still get a refund. So, but it also kind of creates a false sense of security in that some business owners are used to getting earned income credit, not paying much in tax, even though they do have a lot of tax. It's just that earned income credit offsets that self-employment tax. And now the relationship, though, between the business income, self-employment tax, and earned income is very inverse, meaning that when your income goes up, the earned income credit goes down very quickly, and self-employment tax is high. And so maybe one year you got a refund, the next year you owed a lot. So it can blindside people. So you definitely want to hire an accountant just for a little bit, just to see, get an update to where you're going to be at. I am a big advocate of the S corporation. Now, income from an S corporation is not considered earned income. So you need to have a wage that is paid by the corporation in order to get the earned income credit if you qualify for that. So you have to do it anyway to stay in compliance. But you got to remember that even if you're a small business, meaning you have very little and you're used to getting earned income credit, you will not get it with the S corporation if you don't have any compensation through the S corporation. All right, Justin Boche, enrolled agent, owner of Rogue Tax Professionals.